Hey traders, in this video we're going to talk about the bull trap trading setup. Stay tuned. A very warm welcome to you, ladies and gents. Okay, so a bull trap. What is it? How can we take advantage of it? What's the setup? First of all, put yourself in the position. You're looking for a trade, you've drawn your support and resistance lines, or you've drawn your resistance lines, you're looking for a breakout to the upside, you're on a high time frame, it breaks out, you take the trade, maybe it goes in your direction a little bit, then all of a sudden it reverses and stops you out, or worse, if you haven't got a stop in place because you thought it was so good, it comes back down and down and down and down. You get caught, rabbit in the headlights. You don't cover it. It bounces a little bit. You think it's going to come back up, doesn't. And it can actually be the start of what is a devastating trade. But that, we're talking extremes there. Most of the time, you're going to be getting stopped out on it. And it's frustrating, right? You think you've got everything lined up. You've got your ducks in a row. You take the trade, but you get stopped out. However, this happens so often that we can take advantage of this and trade against it. So instead of trading the breakout, we look specifically for the trap. So instead of getting traps yourself, let's look for others who are getting trapped. So this is the bull trap trade. This is based on traders getting trapped in a breakout and then subsequently having to run through the same door to get out of the trade that they're all wrong on. It's a daily time frame chart. So it works best on a daily because the daily candlestick obviously is over a longer duration. More people are getting involved in it because it's over the daily as opposed to a 15 or an hourly. More participants, more likely for there to be an extreme move. Also on a monthly chart, very powerful on a monthly. Fewer signals, but again, higher time frames, that's when it works best on. Markets, liquid markets, your major FX pairs are perfect for this because of the liquidity, because of the participants in it, all works very nicely. And when you're going down to some of the minor pairs, or you're going down to some perhaps smaller market cap stocks or less liquid stocks, this is not going to work so well because you literally don't have that two-way flow and the amount of people trapped in it. So you generally don't get the reversals. That's why often the lower liquidity stuff breaks out and is far more aggressively moving because the supply demand doesn't have to shift that much for it to break through key levels. Okay, any settings on a chart? No, we're using a naked chart here, daily time frame chart, candlestick bars, whatever your preference. Let's have a look. I've got 3 examples for you, and to be honest, guys, it's not hard to see them. You're probably going to see them all day, every day, across the board. Any of the major pairs have them quite frequently. Let's start off with GBP JPY. Right, the idea of this is, and this is a perfect one actually, not too long ago. Well, not too long ago. It's on the daily chart. Just picking the one that shows you really how these things work. So you come along and, classical traders will say, oh yes, I'm just going to draw my resistance line here and I'll look very nice. And we've been sitting in this nice range for a while. There's my ultimate resistance. There's probably another one here, but there's my biggest resistance of the range. All of a sudden now we break through and you can see it looks very tasty, right? We push up, we break through the highs here. You have a good solid close above it, second day follow through. And that's the one that really gets everyone excited, right? Let me just zoom out on this a little bit better. That's the one that gets everyone excited, okay? Breakthrough, close at highs, all aboard this thing. Then we get a little bit of a pullback on this day, say third day or second day, depending how you're counting. And then again, push through, and then things just don't go the way of the buyer. Okay, this in itself is actually a nice little bull flag above highs, nice decent flagpole on it. But then this is where things just go wrong. You push down and you close at lows. Now, if you were long on that stock, on this GBP JPY currency pair, that would be your warning sign to get out of it. That little dip below is fine, and often a little wick, and you can say, fine, we're all aboard, we're going to get back through to highs again, and the breakout's going to happen. When you see this, there is likelihood that this is the start of a significant trap. And I've just got rid of my resistance line there. Let's put it back in so we can see what we're doing. That is the sign and the start of a potential trap. So the idea of the trap is that everybody here is now involved on the long side. Move it back up again. It is involved on the long side. We've got multiple days and multiple amounts of people involved in this, and this thing reverses. It has trapped bulls. It's the bull trap because it looks so sweet. It's got a good strong momentum. It's even flagging above the resistance level. Check the box, all aboard. The better it looks, the sweeter it looks, the more people start to put on the table. then it fails. And the key to trading this bull trap trade is to wait and see where the failure occurs. In fact, you've got two options to trade this. You can fade it immediately, so as soon as you see some kind of failure, and for me it would be this day 3 fake above the high, close at low. Now that to me isn't necessarily an all aboard short trade, but the good thing about that is you can quantify your risk, take the short with a stop above the high, and assuming that this probably is a 50-50 trade, however the risk reward ratio is 10-1 plus, so it works out. If you're bearish on it for whatever reason, you think it's a bull trap trade, that is a good way to take it, but assume that you're going to get stopped out on this very frequently because the breakout trades will just rip to highs. Let's quickly go into AUD/USD. AUD/USD, he seems to exhibit this thing regularly, you know, and this is just an example here of how often this thing occurs. And even, okay, if we look in the broader sense of, all right, here's the resistance level, look how many times you trap bulls. You know, once you trap them here, you trap them here again, you trap them here again. This is not quite as nice as the GBP JPY example, but I like to put them all up there. The point is people are sucked in and are going long, and then this thing is reversing hard on them, and you can see again a beautiful little trade. Euro US dollar, click the one button there. Euro US dollar, let's have a look. Bull trap trade of significant proportions. We have the resistance level here, we have a push through to highs here on a strong candle. Day 2 no, day 3 certainly no, and even though it retests, if you're having your stop above the high, you're fine. Which brings me nicely to where you're going to put your stop. Obviously, if we look at this GBP JPY example, AUD/USD example, Euro US dollar example, the beauty of this trade, which is why it's so nice, is that there's an obvious place for a stop. You don't have to overthink it, you don't have to really be clever about it. It's literally above the high. If it's a genuine trap, it's not going to go above the high. You can go a few pips above the high, 6 pips, 10 pips, 15 pips, whatever you want in order of magnitude of the risk you're already taking. Targets 10x, 3x, whatever you think is the likely scenario. You know, if you're looking at a good way of looking at it, guys, is look, GBP JPY, you're saying there what was 125 pips we worked it out as. You can see how far you've come. We've come up from 128 to 138 to 140, a significant move. So risk to reward ratio is going to be good. It's going to be 10-1, 8-1, 5-1, that order of magnitude, because you can see just by eyeballing it, the distance between the stop and the ultimate target. If you assume the ultimate target is going to be a retest of lows. When we start looking at these other AUD/USD, same kind of thing. Euro US dollar, not so much. You can see because we've got quite a wide stop relative to the range, you might be looking at 3-1. The point is, you use your targets based on what has happened prior. Don't try and force 10-1 on something that's not going to take it. Like 10-1 on this Euro US dollar isn't really right, is it? Because you can see your risk is pretty wide. If you 10 times that, you're going to be looking way at lows. Not saying things can't happen, but you've got to put it into the context. So those are your stops, obvious stops. Those are your targets. Use them compared to what's happened in the chart time frame. And finally, if you want to, go to your lower time frames as well. So look for the bigger picture trade thesis setup, your monthlies or dailies, then go down to your 15s or your hourlies, and if it's happening again on an hourly, which it probably would be in some of these charts as well, because you've not only got a breakout of the broader resistance, you've got one of a shorter term resistance here, then maybe that gives you an extra incentive and confluence to take the trade and to take that short position. All right, guys, keep your risk managed. Whatever you do, take care. Bye-bye.